Okay, so welcome back everyone. This is Mayank Kothari. This is Saturday afternoon at which I am recording this lecture. It has been a great day for me, and this is going to be the last lecture where we will be completing the risk management chapter, the entire risk management chapter. It is going to take around 2 hours to complete the entire all the questions. Like we are going to solve question number 2 to question number 13. 14th and the first one was completed already. Were completed already in the previous lecture. So we are going to just go forward from this point onwards. Okay, great. Before moving ahead, I think I should first take you through the formulas. So this is our chapter that we have started. Just give me a second. Yeah, I think now it's quite visible. Little awkwardness is there. I will see what I can do for that in the next lecture. But for now, I think we can continue. So just have a look. This is our chapter risk management. We have learned these formulas. And we started with the first formula, that is a standard to standardize a normal variable. Okay, couple of requests that I will make is that please take a pen and write down couple of formulas. So to standardize a normal variable means to find out the z-score. It is the observation minus population mean divided by standard deviation, where observation is x, mean, population mean is mu, and in the denominator it is standard deviation. This was the same formula that we used to calculate the var, and in that this x was the var. So please mark in your formula book itself, this is a var. Okay, and whenever we calculate a var, this becomes, the mu becomes 0 always. And once you transfer this standard deviation to this side, it will look like this: standard deviation z-score, this one, into standard deviation, and then this is equal to x, this figure, and x is nothing but the var. Okay, right? So this is what we learn. So var is equal to z-score into standard deviation. So it is the same formula, var is equal to z-score into standard deviation. So var is equal to z-score into standard deviation. If this standard deviation is for multiple days, we can just calculate it by multiplying it with the under root t. 1 day standard deviation into the number of days, under root t. Then var for t days is nothing but var for 1 day. So if you can see here, z-score multiplied by standard deviation of 1 day is nothing but the var for 1 day into under root t. So for calculating var for multiple days, we have 3 different formulas. The standard deviation for multiple days can be calculated with the help of the standard deviation for 1 day into under root t days. If it is standard deviation for 1 week, then it is under root t weeks. Okay. We're going to understand the formula of portfolio variance and portfolio var later on, when the portfolio questions will come in our lecture. Now, right, let's come back to question number 2 now. Now what we are going to do is, question number 2 will be homework. I think it's better to give it as a homework. Why question number 2 should be the homework? Question number 2 is very similar to question number 1. So we had already seen question number 1 in the previous lecture. That's why question number 2 will be your homework. Now I will directly start from question number 3, and this is going to be an interesting part. Have a look. The var on portfolio using a 1 day horizon. So first underline 1 day. See, you have to do all the underlines that I'm asking you in the entire lecture. So be a good guy, be a good girl, disciplined person, disciplined student in fact, and do whatever I am saying for the purpose of getting good marks. Why I am asking you to do all this is, I want you to build good habits of studying. So underline that 1 day horizon. 1 day horizon is USD 100 million. You can clearly see that the var for 1 day is already given to us in the question. So this 100 million is nothing but var for 1 day. Just write down this above 100 million. What is the VAR using 10 days horizon? What we have to calculate is VAR for 10 days. And we have been given only, what we have been given with this is only VAR. So how to calculate VAR for 10 days using VAR for 1 day? The formula is very simple, sir. Instead of all this, what you can do is simply write down like this: VAR for 10 days is equal to VAR for 1 day into under root T. You can convert 1 day VAR into 10 days VAR by multiplying it with the square root of 10. So 100 multiplied by square root of 10. Square root of 10 is nothing but 3.162. That's it. That will give you the figure of $316.20 million. What has been done here is VAR for 10 days is equal to z-score and standard deviation for 10 days. And standard deviation for 10 days is nothing but standard deviation for 1 day into under root T, under root 10. And this z-score into standard deviation of 1 day is nothing but VAR for 1 day. That has been given in the question. So we have calculated this. See, this much of the data has been assumed by me in order to teach you how to interpret. It is not the part of the question. So don't get worried about from where we have taken this 10% and 90%. Now let's take an example or take an assumption that this has been calculated with a 90% confidence interval. Whenever I say 90% confidence interval, it shows the maximum loss. And whenever I say 10% chance, means the opposite side, significance level, it shows at least loss. So 10% shows the minimum loss, 90% shows the maximum loss of 316.23 million for 10 days. 100 million is for 1 day. 316.23 million is for 10 days. Which formula did we use here? Just have a look in the formula book. I will just show you. The third formula, VAR for 10 days is equal to VAR for 1 day into under root 10. So 100 multiplied by under root 10, it gives you the answer. Okay. Now let's come over to question number 4. Question number 4 is also easy. You can take the homework. It is similar to question number 3. So I'm putting it up for you. Now comes question number 5. Question number 5. We can take question number 5. Have a look. Suppose we have a portfolio of $10 million in shares of Microsoft. What is this $10 million? Investment. We have investment in the stocks of Microsoft. We want to calculate VAR at 99% confidence interval over 10-day horizon. So have a look. We want to calculate VAR for 10 days. 99% confidence. Now there are 3 standard numbers which are used most of the time in as a confidence interval, or we can say here confidence level. The more proper word is confidence level. Now, what are those 3 figures for confidence level? 90, 95 and 99%. So if you will look the z-score, if you will look the probability for this, the z-score for this much of the probability, that is 90, 95 and 99. What is this? This is the probability or the chance. You will find these figures. For 99% it's 2.33, 95% it's practically 1.645, but most of the time 1.65 has been taken in the risk management chapter. And for 90% it's around 1.28 or something. So in this question they are saying 99%, that means we have to use z-score of 2.33. See, in the exam they will give you the z-score as well, or they will give you a certain extract from the z table and you will have to pick that 2.33 from that table. But otherwise also there are just 3 numbers which you need to remember all the time while solving all the questions of risk management. The volatility, underline the word volatility, write down standard deviation Also, please put a circle around this word per day. The volatility of 2% has been given for 1 day, and we have been asked to calculate the VAR for 10 days. This is where most of the students are going to make the mistakes. Please understand. Calculate the VAR. Now, VAR for 10 days will be calculated using the same formula, that is VAR for 1 day into under root T. This is the same formula that we used in question number 3. Right? We have this figure under root 10, but we do not have VAR for 1 day. Now, VAR for 1 day, the formula of VAR for 1 day is this: standard deviation for 1 day into Z score. Now, 10 million into 2% will give you standard deviation for 1 day, which is $2 lakh. 10 million into 2%, which gives you $2 lakh. Z score at 99% confidence interval is 2.33 according to the table, and under root T, then you solve it. This is your VAR, 1472,500. How to interpret this? That in 10 days, 99% chances are there that the maximum loss will be 1472,500, or your loss won't go beyond 1472,500, and the chances are 99%. Very simple. What we did in this question is, we used this formula at the end, but for calculating this VAR for 1 day, we had to calculate Z score into standard deviation for 1 day. So practically speaking, we used this formula. We took Z score as 2.33, standard deviation for 1 day as 2% of how much? 10 million. So that's 2 lakh, and this is under root 10. Okay, let's move ahead. Question number 5, question number 6, and this is going to be an interesting question. Have a look. If the daily VAR is 12,500, now the question says that, underline the word daily. First of all, it should be daily. Underline this. This is 1 day VAR. Okay. It is 12,500. So in a day, maximum loss at a given confidence level will be $12,500. Calculate the weekly, monthly, semi-annually and annual VAR. Now please understand that you have to take the number of days in all these periods. Assume 250 days and 50 weeks per year. It is clearly given here that we have to consider 250 days in a year. We will do that. So how many days are there in a year? 250. Considering the 250 annual days, how many days will be there in a semi-annual period? 250 by 2, that is 125. How did we arrive at this? 250 divided by 2, because semi-annual is just half of annual. There are 12 months in a year. If 1 year consists of 250 days, how many days will be covered in 12 months, like each month? So what we are going to do, we are going to divide 250 by 12. It is going to give us around 20.833 as a figure. So we will take round of 21 days in a month. Trading sessions. So if you do the calculation of 250 by 12, it gives you 20.83. Obviously we have to take the whole number, not the decimals, and that's why it is more closer. 20.83 is closer to 21. That's why we are taking 21. How many days are there in a week? See, 50 weeks are there. 50 weeks per year. 250 days per year, 50 weeks per year. What you can just do is 250 divided by 50. Simple. 5 days in a week. And it's very simple. All these 5, 21, 125 and 250 are days, are in terms of days. Just give me a second. Are in terms of days. Why we have taken it in terms of days and not in terms of weeks? Because the data given to us in the beginning itself is daily VAR. Just understand that, let's assume that the question that will be asked in exam gives you a certain change in this data. if the weekly VAR is 12,500, if it says that the VAR given to you is weekly, at that time you will have to take how many weeks are covered in these periods. So this is going to be 1. Weekly 1. How many weeks are there in a month? 4. Or you can do one thing, 50 weeks per year, 50 divided by 12 months. 50 divided by 12, it gives us 4.166, round off to 4. How many weeks are there in a semi-annual period? 25. How did we calculate that? Because there are 50 weeks per annum, half of that will be covered in semi-annual. So if the data would have been given in terms of weeks, this would have been our answer: 1, 4, 25 and 50 weeks. But if the data is given in daily or per day, we have taken all the days for this data. Now the question is very simple. If you have to calculate the VAR for any number of days, you have to use this formula. So VAR for 250 days, under root 250. VAR for 125 days, under root 125. VAR for 21 days, under root 120. 21. VAR for 5 days, under root 5 days. Have a look. VAR for 5 days, 1 day multiplied by under root 5. VAR. 21 days, 1 day multiplied by under root 21. That's it. You take the VAR for 1 day, multiply it with this much. 1 day multiplying with this much, and this much. You will get the answer. So in order to interpret, what we can do is like this. In a year, the maximum loss at a given confidence level will be $197,638. In a semi-annual period, the maximum loss will be $139,750. In a month, the maximum loss will be $57,287, and so on. So it's easy. Are we done with this question number 6? Shall we move ahead with question number 7? With every new question, we are going to learn something, and that question gets difficult. 7th, 8th, 9th, 10th, 11th, 12th and 13th. It will get difficult the moment we solve each question. Have a look on question number 7 now. James has estimated an annual standard deviation. Now, James is a person, he estimated an annual standard deviation, underline the word annual, of 7,50,000 on one of its projects. So what I can do is I will just write down given data. Standard deviation annual is 7,50,000. Based on a normal distribution of return. Underline the word normal distribution. What does this mean? Most of the students will ignore this word because this does not include any figure. It may seem irrelevant to most of the students, but it is not. Normal distribution explains that the entire project's return are normally distributed, means we can form a bell-shaped curve for the returns of this project. And if the bell-shaped curve can be formed, the entire Z-table concept will be applicable to this. The average annual return is $2.4 million. This is the return on which you can lose. Sorry, it's not the VAR. So 2.4 million is the return on which your return can go up by 0.75 million or down by $0.75 million. Okay. Estimate the value at risk at a 95% confidence level. When they say 95%, the answer should be 1.65 Z. When they say 99%, the answer should be 2.33. When they say 90%, the answer should be 1.28. Okay. For 1 year and over the life of 6 years, you have to calculate the VAR for 1 year and VAR for 6 years. How to do that? It's very simple, sir. VAR for any period is equal to Z score into standard deviation for that period. VAR for 1 year. Z score is 1.65 at 95% confidence level if you look at the table. Okay. And standard deviation for 1 year is already given to us, that is $7,50,000. With this we arrive at a figure of var for 1 year. That means 95% chances are there that your maximum loss will be 1.2375 million or $12,37,500. The opposite of that is also true, that instead of 95% you can say 5% of the time, or 5% at 5% significance level, your loss will be at least 12,37,500. So 95% of the time we will lose maximum of 12,37,500 in a year, because it says about 1 year. So these two words are very important. In terms of confidence level, we say it is maximum loss. In terms of significance level, it is the minimum loss at least. And when we have to convert the var for 6 years, the var for 1 year will be useful. See, Z score into standard deviation for 6 years. How to calculate the standard deviation for 6 years? Standard deviation for 1 year multiplied by under root 6, that is 2.45. We can calculate it, we can just write it down like this. The details are not given there, that's why. Z score into standard deviation of 6 years. The shortcut will also help. Z score into standard deviation of 1 year into under root t, and this much of the area is called as var for 1 year, which has already been calculated by us. Var for 1 year is 30,31,1875. Okay, multiplied by under root 6. So if we do under root 6, it goes to 2.45. $7428093. Okay, that's my mistake. It's not 30, it should be 12,37,500. The 1 year var 12,37,500, and then this answer will be arrived. 12,37,500 into 2.45, 30,31,875. There is one correction. Please remove this 1 after the dollar. That is just a printing mistake which we have to correct. 30,31,875 is the maximum that we will lose at 95% confidence level in 6 years. Now this 30 lakhs is in 6 years, the loss. Are we cool with this? We could have directly used this formula instead of all this. Var for 6 years can be just written as var for 1 year into under root t. Okay, now let's come to question number 8. And question number 8 covers up one concept. Question number 8 includes one concept from the portfolio management chapter. So I will just explain that concept before taking up this question. Have a look. First of all, let me ask you, what is the measure of risk? Measure of risk. First is the standard deviation that we have learned. Second measure of risk that we have learned was VAR. It shows profit and loss both. It shows only about loss. The third measure of risk that we are going to discuss in portfolio management chapter is beta. BETA. Beta is denoted by this symbol. Beta. Okay. And the beta can be -3, -2, -1, 0, 1, 2, 3, 4, 5. Anything at any level. Like it can go, there is no limit to it. It can be 0.25, it's like -2.5 as well, 0.35 as well, anything. The more important is to understand the logic of beta. Okay, let's say for example I invest in the entire market, equity market, and I also invest in one of the shares, that is Tata Motors. By default, the beta of the entire market is 1. It is by default. That is the base with which we are going to compare every other stock. And let's say that beta of Tata Motors is 0.9. What does that mean? First of all, the beta means risk. And we can clearly see that the risk of Tata Motors is lesser than the risk of market. Okay. If the risk is less, the returns will also be less. The loss will also be less. So let's just do one thing. Let's find out the returns. If I write down the returns here, and let's say the market is giving us a positive return of 10%. What do you think the return of Tata Motors will be theoretically? It's very simple, sir. At one risk, if we are getting 10% return, at 0.9 risk, we should get 9% return. Am I right? Proportionate. Proportionate. So 10 multiplied by 0.9 will give you 9%. Okay, one more. Let's say your return is minus 10%, means it is going down. So what will be the return of Tata Motors? It will be minus 9%. It will be minus 9%. You can clearly see that when this beta is given, this 0.9 indicates the extent to which the Tata Motors will move in the same direction. You can see both are going down, both are going up. So there are two components of this 0.9. One is the positive sign here. No sign in front of a figure is assumed as positive sign. So positive sign indicates direction, in which direction the shares will give return, and it is same direction if the positive sign is given. Okay. And this 0.9 explains us the extent to which the returns will move, how much the returns will move as compared to market. Let's take another example of minus 0.9. If the beta is not positive, let's say it is negative. What will happen? If the market gives us the return of 10%, the stock will give a loss of 9%. 10 multiplied by 0.9. 0.9 negative. So 10 into negative 0.9 will give you the return of 9%, negative 9%. So share market is going up and the Tata Motor is going down because of the negative beta. Again, if the Tata Motors, if the market goes down, Tata Motors will go up in that case. Here, there are two components of the beta. One is the negative sign. Negative sign indicates the direction of the movement of that stock as compared to market, and it is always opposite. And 0.9 explains you about the extent to which the stocks will move. So this is what it is. And if the beta is 0, that is, there is no relation between the two things. So this means this is the beta. Beta explains, beta is first of all the measure of risk. It is shown not in the percentage term, it is shown in the index term. So minus 3, minus 2, 1, 0, 1, 2, 3, 4, 5, or any figure in between that in decimals. Beta basically has two things in there. The sign which indicates the same direction or opposite direction, and the extent to which the shares will move as compared to the market. Okay, this share is already included in the market, right? Now come to the question and just have a look on it. It is going to be a good discussion. A trader has an allocation equal to 8% of the firm's capital. So first of all, we are going to just draw the firm's capital part. Let's say, for example, this is the firm's capital, no matter how much amount is given. It is written that out of the total firm's capital, one trader is managing 8% of the total capital. So what we can do is we can just calculate, we can just draw his area in the total. So trader is managing 8% of the firm's capital. Good enough. Now, the firm's daily VAR is $120 million. The VAR of the firm is 120 million. What do you think the VAR of the trader should be? Based on this much of the data, the VAR of the trader should be 120 into 8%, because 120 is at 100%. What will be the trader's VAR? 120 into 8%. But that is not just enough. Have a look. What should be the VAR allocated to trader unit? What should be the VAR allocated to trader unit? Right. Now have a look. This is firm and this is trader. This is $120 million, or let's just take an example of 100 rupees. Okay, cool. Let's just take an example, another example. Let's say the firm's value, the return is 100 rupees, and if we are earning 10% on it, the return will be 10 rupees. Am I right? What will be the trader's return in that case? First of all, the trader is only covering up 8% of the fund's capital. So out of the return also he will get 8%, which will be 8 rupees. But the return of the firm, the return of the trader is not equal to the return of the firm, because they have a beta of 0.9 with them. So the return of the trader will be 9%. So 9% of 8 will be 7.2. This is the return of the trader. How did we arrive at the return of the trader? It's very simple. Trader's return is nothing but firm's return of 100 rupees multiplied by the allotted share and multiplied by the beta, that is 0.9. It gives you 7.2. In the same way, we have to keep it VAR of the firm into allotted area into beta. What did we calculate with this? The VAR for trader. Simple. We cannot simply take 10% as well for the beta trader. So have a look. VAR for the trader. Trader is included in the firm. So for the entire firm, the loss is 120, and trader covers up around 8% of the total firm. So we could have clearly said that the total loss of the trader would have been 120 into 8%, provided the risk of the firm and the risk of the trader would have been same, but it is not. The risk of the firm will be assumed as 1 and the risk of the trader will be assumed as 0.9. So it is clear that the risk of the trader is lesser than the firm. Hence, we will incorporate that also. So instead of 9.60 as the VAR, it will be 8.64. Means the 90% or 0.9 of $9.60. That's it. This much is the only answer. It is just like that. This is 120. You calculated 8% of it and then multiplied it with the beta in order to arrive at the final answer. Why we are multiplying it with the beta? Because we want to incorporate a different risk for trader, because the risk of the firm was 1 and the risk of the trader is 0.9. So reduced risk means reduced loss. That's why from 9.60 it has come down to 8.64, because we multiplied it with the 0.9 thing. So this is all about question number 8. Have a look on question number 9. And before starting question number 9, I will have to explain a couple of things related to portfolio variance and portfolio VAR. So let's just take a break of 5 minutes and then I will be back with question number 9, understanding the new concept of portfolio VAR. Okay, so welcome back after the break. This is going to be question number 9. Have a look on this. Following is the information about Mr. J's portfolio. Mr. J has created a portfolio and he has invested in shares of ABC Limited and XYZ Limited. Okay, so we will call it as A and X. If we just have to represent these companies in one letter, you can clearly see that Mr. J has invested equal amount in both the shares ABC and XYZ, 200 lakhs and 200 lakhs. The total is 400 lakhs. The weight of investment is 50-50%, clearly. The daily, underline, daily standard deviation of both shares is 1%. It means 1% for both. If you apply it for 400 lakh, it will be 4 lakhs. If you apply it for 200 lakhs, it will be 2 lakhs, and 200 lakhs, it will be 2 lakhs. So 2 lakhs separately. The daily standard deviation is same for both the shares. It can go up by 2 lakh rupees or down by 2 lakh rupees. Okay. Coefficient of correlation between both the shares, we will call it as RAX, is 0.3. That means if one share is moving up by 10%, the another share will move up by 10 into 0.3, that is 3%. First of all, the correlation coefficient is positive here. So the direction of movement of both the shares will be same. Either both will go up or both will go down. Second, 0.3 shows the extent to which the shares will go. That is only 0.3 of the other share. Now, what you are required to determine is 10 days VAR. First of all, it should be very clear to you that if they are asking you to calculate 10 days VAR, the standard deviation should also have been of 10 days. Here it is only for 1 day. Okay. For Mr. J's portfolio, it's not just for the ABC Limited or XYZ Limited. They are asking you to calculate the VAR of the portfolio, which includes both the share. At that time, we will need standard deviation of the portfolio, not just each share, which has been given here. The Z score from the normal table for 99% is 2.33. Even if it is not given, it should be in your memory by now or after solving all the questions, because the standard practice is only 3 numbers are used for the confidence level, which is 90, 95 and 99%. And if you look at the table values for this, Z table values for this, it will be 1.28. I think this is going to be 1.65. Proper value is 1.645, but mostly 1.65 is being used, and this is 2.33. So if they are saying 99%, it is going to be 2.33. Show up your calculation up to 4 decimal points. This is also important. You will have to keep this in mind. Good. Now let's go ahead and write down the portfolio. If we need a portfolio VAR, we should have a standard deviation of the portfolio. So let's look at this. VAR of the portfolio is equal to standard deviation of the portfolio into Z score into under root T. Why that is under root T? See, if this is for 10 days and this is for 1 day, at that time only you will need under root T. So it is not clear in the formula written over here. Just write down below portfolio 10 and below standard deviation portfolio 1. So it is being clear to you that you are converting the portfolio standard deviation of 1 day into 10 days by multiplying it with under root T. Okay, that's great, sir. We know the T value, which is 10. We know the Z score value, which is 2.33. So the only thing left is to understand or to calculate the portfolio standard deviation for 1 day. Okay. Now how to calculate the portfolio standard deviation? That is very easy. We will go step by step. First, in order to calculate VAR of the portfolio for 10 days, we need standard deviation of the portfolio for 10 days. Very clear. Standard deviation of the portfolio for standard deviation of the portfolio for 10 days is equal to standard deviation of the portfolio for 1 day into under root t. So we have the t then, or we can just write it down like this. Into z-score. Now for standard deviation of 10 days, it is standard deviation of the portfolio for 1 day into under root t. Now we have two figures. We already have under root t value. We also have z-score value. All in all, what we have to calculate is the standard deviation of the portfolio. And for portfolio, it is nothing but v square root of the variance of the portfolio for 1 day. Now, the ultimate thing that we have to calculate is the variance of the portfolio. Now, when it comes to variance of the portfolio, which is in square, which is written out like this, standard deviation p square. How to do that? In the basics before risk management lecture, we learned how to calculate the variance of the portfolio. So it was, now when it is calculated in terms of percentage, it was like this. Standard deviation of a square, weight of a square, plus standard deviation of x square, weight of x square, plus 2 into standard deviation of a, weight of a, standard deviation of x, weight of x. And then RAX. Am I right? This was the formula of calculating portfolio standard deviation. This is what we learned in the basics before risk management chapter. Okay, cool. But this is not what we are going to use in here. The formula that we will be using is for calculating the portfolio variance for rupees or any currency. That means not in percentage but in currency. At that time, the portfolio standard deviation square means the variance will be calculated as follows. Standard deviation of a square plus standard deviation of x square plus 2 into standard deviation of a, standard deviation of x, RAX. There are a few figures that I have missed in the formula, which is weight of a square, weight of x square, weight of a, and weight of x. All in all, we can summarize that the difference between these two formulas are we are not including weights while calculating the variance in any currency. If you want to calculate the variance in terms of percentage, you have to use weights, but when you calculate the variance in terms of currency, you should not use the weights. Now the question lies here that why? First of all, the concept is same in both the cases. It is also variance, this is also variance. Then what is the logic of not using weights while calculating the variance in currency? Now let me show you, and then we will get back to our question of using this formula. Okay. Let's say there are two shares A and X. You have invested 100 crore and 100 crore in this. 100 crore, 100 lakhs, any figure you can take. Okay. The returns, let's say the weight is now 0.5. Let's say the return of these two shares are 10% and 15%. Instead of 15%, let's take 20%. It will be easy for our calculation. Now, if I want to calculate the portfolio return, what you will do? We have learned that the return of the portfolio is nothing but individual return multiplied by individual weight and then summation. So 10% into 0.50 will give us 5. If we multiply the return of A with the weight of A, it will give us 5%. Then this will be 10%, 20% into 0.50, and the total of it will be 15%. Okay, the total investment is 200 lakhs. Now if we 200 lakhs or crores, now we apply this portfolio return on portfolio investment, we will get a value of 30 lakhs. If it is in lakhs, 15% on 200 gives you 30 lakhs. So this is one way of calculating portfolio return. But I will tell you there is another way. You just simply multiply 100 lakhs with 10% directly. 100 lakhs, 10%. That is 10% return on 100 lakhs gives you 10 lakh, and 20% on 100 lakh gives you 20 lakhs. This is in rupees, this is in rupees, and the total is also 30. So this is another way. Now you compare both the methods of calculating the portfolio return of 30 lakhs. When you are calculating the return of 30 lakhs, understand, and when you are using the percentage of 15%, this 15, you will see that the 15% is calculated using weights, but this 10 and 20 lakh rupees are not calculated using weights. You do not have to use any kind of weight while calculating 10 lakh rupees or while calculating 20 lakh rupees. We simply multiply the investment with the return. In weight will not come anywhere in between this. You can easily see. But while calculating the percentage, you had to multiply the weight with the return. 10 into 0.5, 20 into 0.5. But while calculating here, we do not have to use the weight. So it is very clear to us, and it is logical that if you are calculating in terms of rupees, that is 10 lakh plus 20 lakh is equal to 30 lakhs, there is no need to use the weights. That's why when we are calculating in the currency, there is no need to use the weights. Obviously, in terms of percentage, we are using the weights here as well. So the logic is very clear to you. Now we can use the formula. Let's go ahead and use the formula. So again, I will start from this point. The purpose is to calculate the portfolio VAR for 10 days. For that, we need a portfolio standard deviation for 10 days into z-score. We have the z-score, we need this figure, and this figure is calculated with this formula, standard deviation of the portfolio for 1 day into under root t. We have under root t, like under root 10. Now we need standard deviation of the portfolio for 1 day. For that, we need variance of the portfolio for 1 day, so that we can square root it and then we can arrive at this figure. Now how to calculate the variance of the portfolio for 1 day? This is the formula. Variance of the portfolio for 1 day. So shall I use it? Let's go ahead. Variance of the portfolio for 1 day is equal to standard deviation of a square plus standard deviation of x square plus 2 into standard deviation of a, standard deviation of x, r a x. What is the standard deviation of a? Oh, this is all in terms of currency, not in terms of percentage. Please understand. So you will have to take all the figures of standard deviation in rupees, right? So I can write down like this: 100 lakhs into 1% square plus 100 lakhs into 1% square plus 2 into how much is the 100 lakh into 1%? 1 into 1. They have invested 100 lakhs or 200? Sorry, that is 200 lakhs. So I will just correct myself. 200 lakhs into 1% square plus 200 lakhs into 1% square plus how much is the 200 lakh into 1%? That is 2 lakhs, right? 2 into 2 lakhs into 2 lakhs into the correlation coefficient, which is 0.3. Okay, let's just do the calculation. This is 2 in 2 square in 2 square 4 plus 2 square 4 plus 2 into 2 into 2 8 into 0.3, that is 2.4. So the total goes to 10.4. And this is in lakhs or crores? This is lakhs. So I will just write it down, 10.4 lakhs. Why I am putting a sign of rupees? So that I should know that this is not in percentage. Everything here that I have taken is in rupees. And this is variance for 1 day. If we square root this figure, we will get standard deviation of the portfolio for 1 day. that is 3.22 2249. Four digits, right? We should take 4 digits. Question clearly specifies that. Now we will calculate the VAR of the portfolio for 10 days. Have a look on this formula. Standard deviation of the portfolio for 1 day into under root t, that becomes the standard deviation for 10 days, into z score. Am I right? So 3.2249 into under root 10 into 2.33. Z score is 2.33. So 3.2249 into the under root 10 value is 3.1623, 4 decimals into 2.33. This is going to be the final answer. $23.76. VAR of the portfolio for 10 days. Are you getting it? Just a second. So this is our VAR of the portfolio for 10 days, and this is how we have to calculate. I will just summarize this thing, and it's very easy. For VAR of the portfolio of 10 days, we had to calculate the VAR for, standard deviation of the portfolio for 10 days. And for that, we needed standard deviation of the portfolio for 1 day. So we did all this process. All in all, your question in exam, your answer in exam will start from this point to this point. That's it. This much is the only answer to this. First, you will calculate the portfolio variance for 1 day, then you will convert it into standard deviation, then you will put it in the VAR of the portfolio for 10 days formula. Let's go ahead. This is the question. Where is your answer? 23.73 lakhs. You can clearly see it here. Are you getting it? Now now you got to know that how to calculate the portfolio VAR. What I want you to do is just repeat this in question number 10, because this is similar. Instead of 200 lakh, they have invested 1 lakh only in each A and B. They have 1% standard deviation each, like the previous question. The coefficient of correlation is also same like the previous question. Instead of 10 days, they want you to calculate the 5-day VAR at 99%. The value is 2.33. Are you getting it? So you will go through it again and you will find out this is the answer. Okay. This is the formula that we used in this example, the one we have just solved. Shall we move to question number 11? This is an interesting 11, 12 and 13. All the three questions are little different, but this is going to be an interesting one. So have a look on question number 11. The Westover fund is a portfolio consisting of 42% fixed income investment. Now the Westover fund is an entirely a fund. Okay. It includes two types of assets: fixed income investment and equity investments. The weightage of both is also given to us. So what we can do here is, let's create a portfolio. We will call it as bond portfolio, and this is going to be equity portfolio. Now you need to understand one thing, that there are many instruments in the market which gives you fixed income, and bond is one of them. You can invest in the FD also, fixed deposit of the banks. Okay, cool. The weight of both is 0.42 and 0.58. Means out of total investment, 58% have been invested in equity and 42% have been invested in bond. Okay. Now, the manager of the Westover fund recently estimated that the annual, underline this word, VAR at 5% significance level. The 5% given in the bracket will automatically be assumed as a significance level and not the confidence level. Now you may ask, sir, why is that? Where it is written that 5% is the significance level and why you are not taking it as confidence level? So this is industry standard practice that confidence level most of the time is being used as like this and significance level is being used like these numbers. So higher number indicates the confidence level, although it is not a rule, but this is the practice. And the lower number, that is 10, 5 or 1, indicates the significance level. So 5% means at 95% confidence we want to calculate the answer, and at 90% we know the z-score value is 1.65. Okay, let's move ahead. Assuming a 250-day year for the entire portfolio was 1367,000. So the VAR of the entire portfolio was 1367,000. This is the portfolio VAR. Okay. Based on the portfolio's market value of 12,428,000 and a correlation coefficient between the stocks and the bonds. Understand, stock means equity, bonds the fixed income, it is 0. So the correlation coefficient between bond and equity is equal to 0. Cool. If the annual underline loss in the equity position is only expected to exceed 1.153 million 5% of the time. See, the entire statement has only one word. If you want to express it in one word, it is called as VAR. The institute or the question maker is very smart. If they want to check your conceptual knowledge, they have given the meaning of the VAR. They have written the meaning of the VAR, means a loss in a particular investment which is expected to exceed this much of the amount, that is 1153000, 5% of the time. Instead of that entire statement, they could have simply written VAR is 1153000 at 5% significance. But no, they have written it in a different format, which is the meaning of that. So unless and until you understand the meaning of the VAR, you will not be able to understand that 1153000 is a VAR for equity. So this is a equity VAR. And we will write it here 1153,000. But please make sure that equity VAR is also annual. Yes sir, this is annual. The portfolio VAR was also annual. Okay. Now, the very important thing is this word. Then, what is the daily expected loss in the bond position that will be exceeded 5% of the time? 5% shows the minimum loss, right? Significance level shows the minimum loss. So the minimum loss, how much will be the minimum loss in the bond position? That too also daily, not annual. So if you calculate a figure of this, it will be called as the bond VAR for 1 year or an annual VAR of the bond. We do not want that. We want the daily VAR. We want to calculate the bond VAR for 1 day. For that we will need the bond VAR for per annum. Now have a look here. The purpose is to calculate the VAR of the bond, and that too daily. How it is calculated? If we calculate the VAR bond for 1 year, that means 250 days, we will be able to calculate the VAR of the bond for 1 day, and that is calculated using this formula. Am I right? VAR of the bond for 250 days is equal to VAR of the bond for 1 day under root T. Cool. We know this figure that under root T is nothing but under root 250. Now, in order to calculate VAR of the bond for 1 day, we will have to calculate VAR of the bond for 1 year. How to do that? For this, you will need to understand that var of the bond for 250 days is equal to standard deviation of the bond for 250 days into z-score. This is the basic formula for any var calculation. We know the z-score value, that is 1.65. But now we need standard deviation of the bond for 250 days, and this is not given to us in the question. But we can calculate that standard deviation of the bond if we know the portfolio standard deviation and the equity standard deviation. But both of these are also not given in the question. Now you will have to first calculate the portfolio standard deviation. For that you need portfolio variance. Again you will have to calculate the equity standard deviation. For that you will need equity variance. Now this process is little lengthy if we follow the approach of calculating standard deviation of the bond. So instead of this process, instead of this approach, we can calculate the similar answer with a different approach. Have a look. You remember how to calculate the variance of the portfolio? It is very simple. Standard deviation of bond square plus standard deviation of equity square plus 2 into standard deviation of bond, standard deviation of equity, R of bond and equity. This is how we used to calculate the standard deviation of the portfolio square. That means variance. Okay. In the similar manner, we can calculate the var of the portfolio square. It is very easy. Var of the bond square plus var of the equity square plus 2 into var of the bond, var of equity, and correlation coefficient of bond and equity. Now let's start putting figures in here. The very first figure is the portfolio var, which is given to us 1367000. We cannot put the entire figure, as if we are going to square it, it is going to give us a large number to write on the paper. So instead of this, we will take the figures in millions, and that will be 1.367. So 1.367 square is equal to 1.153 square, sorry, this is equity, so I will just write it down here, plus var of the bond square. Also in the question, this value of correlation coefficient is given to you as a 0, and this makes the entire term, the third term, as 0. And now if we solve this question, var of the bond square is equal to 1.367, that is 1.8687 divided by 1.3294. This gives us 1.4057, and if you put a square root, we will get a var of the bond for 250 days, that is annual, and that is 1.1856. 1.1856. This is the bond of 1.185610 per annum var of the bond. We want per day. Now you can put that figure in here, 1.18561, 1.18561 0, 123 123. Am I right? Right. Now if we solve this, we will get the answer to our var of the bond for 1 day. So 250 square root is 15.8114. So 1185610 divided by 15.8114. It gives you var of the bond as 74,985. Did you understand now how we calculated this? Just have a look. I think we have made some mistake somewhere. Acha, in the calculation of this itself. 1.153 1.153 Let me just find out. 1.3294, 1.8687. So what did we do wrong? 1.8687. Okay, we will have to deduct, not, so we were wrong at this point. We will have to change the answer a little. Let me just correct myself. It will be like this. 1.367 square is 1.8687 minus 1.3294. It should have been subtraction instead of division. That's where I did wrong. It goes to 0.5393, and if you put a square root for that, you will get the war bond for 1 year, that is 0.734370. Okay, enough for this. This is the per annum var, and we want to convert it into 1 day var. So let's put it here. 0.734370 is equal to, this T will be how much? 250. Am I right? And if we calculate the 250, it will be square root of 250. It will be 15.811. And now if we will solve it, it will give us the answer 0.73437 divided by 15.811. That goes to 0.046447. That is $46,447 is the var for 1 day of bond. VAR for 1 day of bond. So for 1 day, first we calculated per annum VAR, and for per annum VAR, we had to follow this method. That's it. This is the answer, 46,450. Although it was looking like a small answer, but it has deep meaning. Now let's go on for question number 12. This is also interesting question. Consider a portfolio with 2 foreign currencies. Now this time there are no bond and equities. This time there are 2 currencies. The one is Canadian dollar. The ISO code, means the short form for that, which is being used in the entire world, is CAD. The first 2 letter indicates the country. That means CA means the Canada and D means the dollar. And here it is euro, EUR. So for India, it is INR. IN represents India, and rupee, the third letter R, indicates the currency, that is rupee. These 2 currencies are uncorrelated. Please underline this and mark here RCE. C means Canadian dollar, E means euro, is 0. If correlation coefficient is 0, you should clearly get into your mind that the third term will automatically become 0, like it was in this question. This entire part became 0 because of that one uncorrelated figure. And have volatility. Just underline the word volatility and write it here, standard deviation. Volatility against the dollar of 5% and 12%. What is this dollar? This is US dollar. This is the currency that you are investing in, Canadian dollar and euro. Like in this example, we were investing rupee into fixed income investment and equity. See, we were having INR and we were putting that amount into fixed income securities and equity, or I should write bond and equity. In this question, we have US dollar and we are putting that amount into Canadian dollar and euro. Understood? Now, the standard deviation of Canadian dollar is 5% and 12% for euro. So SD for Canadian dollar is 5% and SD for euro is 12%. Okay, good enough. The portfolio has $2 million invested in Canadian dollar and $1 million US dollar invested in euro. So let's just draw a table here which will be easy for us to understand. So the currencies are here, Canadian dollar and euro. The amount invested in both is 2 million in Canadian dollar, 1 million in euro. The standard deviation is 5% and 12%. So this is USD, this is standard deviation. Okay. What else is given to us? What is the portfolio VAR at 95% confidence level? The moment you see 95% confidence level, the Z is 1.65. There are three standard numbers for confidence level which is being used in the entire market. For 90% confidence level, the Z-score is 1.28, 95% it is 1.65, 99% it is 2.33. So we have 1.65. Okay. Now, what they are asking us to calculate is the portfolio VAR at 95% confidence level. Okay, what is the impact of diversification? We will look after it. Suppose we increase the Canadian dollar by position by $10,000. What is the marginal VAR? We will just look after that. So, sorry, there are three answers that we have to calculate. First, portfolio VAR, impact of diversification, and marginal VAR. Let's just come here and I will show you. There are two different ways of calculating the portfolio VAR. The first way, portfolio VAR of the portfolio is equal to, the simplest way is take the standard deviation of the portfolio and then multiply it with the Z-score. Z-score in our case is 1.65 clearly. And we can calculate the standard deviation of the portfolio. This is one way. For standard deviation of the portfolio, we will need standard deviation of the portfolio square. That means the variance. And the variance can be calculated with this formula. Have a look. Standard deviation of the Canadian dollar square plus standard deviation of the euro square plus 2 into standard deviation of the Canadian dollar, standard deviation of the euro. Let me just take all these figures a little on the left side so that I get space. And correlation coefficient of CE. Okay. If we solve this, we know that correlation coefficient between Canadian dollar and euro is 0. So this entire terms becomes 0. Now we have the standard deviation of both the figures, Canadian dollar and euro. Let's just write it down. How much is the total investment in Canadian dollar? It is 2 million. $2 million is the investment in Canadian dollar. 2000000. I think we have written it wrong. We should add one more zeros here. So 2 million into 5% is the standard deviation of Canadian dollar in terms of currency, plus 1 million into how much percentage? 12% is the standard deviation for euro, and the rest of the figure will become 0 because the correlation coefficient is 0. Let's just solve this. Into 5%. Okay, this figure is going to go large. We will have to just reduce the calculation to millions instead of entire figure. So I am just revising the format from entire figure to millions. So 2 million into 5%. This is the standard deviation, then square, plus 1 million into 12%, square, plus 0. Okay. So 2 into 5% square is 0.01, plus 1 into 12% square is 0.0144, plus 0. The total goes to 0.0244. This is the portfolio standard deviation square. If we put a square root on this, we will get 0.1560205 as the standard deviation of the portfolio. We are going to take this figure and put it here. And if we do that, 0.156205 into 1.65. The VAR of the portfolio will be in millions 0.297998, that is 29 in millions, na 123,297,998 dollars. Let's see if this is right or wrong. There is something missing on our side. There might be some calculation error on our side. Let's just find it out. 1562 and 1.65. 0.1562 into 1.65. 25773. Acha. It's a simple calculation. 156205 into 0.1. Everything is right. No calculations are wrong on our side. Let's just write it down. 0.25774, that is 7738. Let me write it down again. 7738, that is 257,738. 2,57,738. You can just cross check here. 2,57,738. This is one way if we go through standard deviation of the portfolio, but there is another way that we learned in the previous example, which is like this. VAR of the portfolio. For VAR of the portfolio, we can use VAR of the portfolio square. And let me just do it here. VAR of the portfolio square is nothing but VAR of the Canadian dollar square plus VAR of the euro square plus 2 into VAR of the Canadian dollar, VAR of the euro, and RCE. This entire figure will become 0 because the correlation coefficient is 0. Now, in order to calculate VAR of the portfolio square, we will have to first calculate VAR of the Canadian dollar and VAR of the euro. So, this is going to be a little lengthy process, I think. First, we will calculate VAR of the Canadian dollar. So, that is nothing but standard deviation of the Canadian dollar into z-score. That is $2 million into 5% is the standard deviation of the Canadian dollar into z-score 1.65. So this gives you the figure of 1.165 millions. Again, we will calculate VAR of the euro, which is standard deviation of the euro into z-score. This is 1 million into 12% into 1.65. So this will give you somewhere the figure of 0.198. Okay, 0.198. Now you have two figures for VAR of the Canadian dollar and VAR of the euro. You can put these figures in this formula. 0.165 square plus 0.198 square. Let's just write it down. And the total goes to 0.066429. VAR of the portfolio square. And if we do the square root of this figure, we will get an answer of 0.257738. Again, the same answer. So this is one way. This is one way. If you want to go through this formula, just let me just highlight the formulas. This is one formula, or this is another formula. You can choose both. Let me just summarize. Yeah, this much. You can choose any method. The answer will be same, 257738. In the institute has given you both the ways of calculating the answer. Now have a look. First, they calculated VAR of the Canadian dollar and VAR of the euro, which was 0.165 and 0.198. Then they used these two VAR in here in this formula. If you remember this formula, this entire figure becomes 0 and the answer comes to 0.066429, which is the square, means variance. And if you put a square root, you will get this answer. Otherwise also the VAR of the portfolio can be calculated using this method. And then it goes to 25773. Okay, that's enough. Now let me just answer the next question. They says that what is the impact of diversification, and if you remember, we used this word of diversification in a lecture of basics before risk management. And what do you mean by the diversification is that instead of investing entire money into one asset, let's say that you have around 100 rupees, and instead of putting entire 100 rupees in Tata Motors share, if you put 50 rupees in Tata Motors and rest of the 50 rupees in, let's say, Reliance. So this process of spreading your investment is called as diversification. And what is the benefit of this is risk can be reduced. This is what we learned in that chapter, in that lecture. Risk can be reduced. If there is no risk reduction, the total risk will be the risk of the portfolio will be the total risk of these two shares. Let's just find out. If there would have been no risk reduction, just understand, we invested in both Canadian dollar also and euro also, and the loss in Canadian dollar is $165,000 and the loss in euro is $198,000. See, if you total these figures, it comes to 363,000. That means, what does that mean? If you invest in both Canadian dollar in euro, the loss will be 363. But in actual, if you go and see the loss of the portfolio, it is 257,738. That means the loss, actual loss, is less than the total of these two losses. It is lesser than 363, right? What does that mean? That means the diversification has resulted into risk reduction. When you invested in both the assets, both the currencies, it reduced the risk from the total of these two individual risks. So what is that we are going to write? If there is no diversion, just correct me, make a correction here. If there is no diversification, I will just make the correction in the next edition. Okay. So if there is no diversification, VAR of the portfolio will simply be the total of the individual VARs, which is 363. But the actual VAR is 257 that we calculated. And you can clearly see that the total of the two VAR is higher than the actual VAR of the portfolio. That means diversification has resulted into risk reduction. The impact of diversification is that one thing only, risk reduction. Okay, we are cool with it. Now we have been asked to calculate the marginal VAR. Let me just clear one thing. Marginal means the extra. Question is asking you what is the extra VAR. And now whenever you want to calculate extra, you should know the previous figure, that what was the old VAR. What was the old VAR? If we increase the position of Canadian dollar by $10,000, you can clearly see that the total position in the Canadian dollar is 2 million. And if you do one thing, you increase the Canadian dollar position, let's say by $10,000, you will put 1 here. So it will be 2.01, right? Instead of 2, here you will write 2.01. Accordingly, the VAR of the Canadian dollar will change. They are asking you to calculate the portfolio VAR again, new portfolio VAR, and compare it with the old portfolio VAR, and then tell me what is the extra VAR that is being incurred. You just have to change one figure. Instead of 2 million Canadian dollar, change it to 2.01. The moment you change it to 2.01, this figure will change. Let's just calculate 2.01 into 5% into 1.65. So this figure will become 0.165825. Now take this figure and this figure to calculate the portfolio VAR. Square of this and square of this will be the portfolio VAR, because the correlation coefficient is 0. See what they have done here. You need to do the correction here as well. So new portfolio VAR is new Canadian VAR and new Euro VAR square. and this will be 0, the third term. See, 2.01 is the new position in Canadian dollar, and 5% of that will give you the standard deviation, which is this figure. In total, the VAR of the portfolio square, Canadian dollar square, is 0.0275. For the euro, the figure is same. You can clearly see for the euro, 0.1998 is the same figure. Now, if we do the calculation, the new VAR comes down to VAR of the portfolio square 0.0667, and if you do the square root of it, 0.0667, it comes down to 0.258263. Okay, this is the new VAR, 258,263. There is one correction that you have to do is 258, it should be 263 instead of 623 here. And your answer will be $533. You can clearly see by increasing the Canadian dollar position by $10,000, your VAR has increased by $533. Canadian dollar, euro. You had $2 and $1 million position earlier. At that time, the VAR of the portfolio was 257730. But the moment you increase the Canadian dollar position by 10,000, the VAR of the portfolio changes to 263. And there is an increment of $533. So with an increment of $10,000, you can see the VAR has increased by 533. 533 divided by 10,000, roughly 5.33% increment in the VAR of the total. That's it. This is the marginal VAR, means the extra VAR. So you just change the figure of Canadian dollar, calculate the VAR of the portfolio again, and deduct it from the old VAR. You will get the answer. So this was pretty good question, I think. Question number 13 is going to be an amazing question. This is the last question of your entire chapter, and then we will shift to the next chapter. But if you have really understood the concept of VAR, you will be able to solve this question, because this question is little difficult from the rest of the question. Let me just explain. In this question, VAR will be given to you and you will have to calculate the investment value, that how much you should invest in order to arrive at that VAR. So let's just solve this question. Read this question, understand it, and solve it. This is going to be the last question, an interesting one. Have a look. If you want to take a break, you can do that, but I'm starting now. On Tuesday morning, understand this, on Tuesday morning before opening of the capital market, where you trade for equity shares, derivatives, call, future, option, etc. Now, an investor, while going through his bank statement, has observed that an amount of 7 lakhs is lying in his bank account. So what he did in the Tuesday morning, on the Tuesday morning before 9:15 a.m., he saw his bank statement and there was 7 lakh rupees in his bank account. Now, this amount is available for use from Tuesday till Friday. These are 4 days. Tuesday, Wednesday, Thursday, Friday. 4 days. He can use that much of the amount. The bank requires a minimum balance of 1000 rupees all the time. It means you cannot use entirely 7 lakh rupees. The amount that you will have to keep all the time in your bank account is 1000. So you can withdraw almost around 6,99,000 only from the bank. Why you will do that? Because in order to trade in the capital market, you will have to first transfer the amount from bank account to your trading account, or we can say capital market account. So trading account, in order to transfer the amount to trading account, you will need to understand that this is the maximum amount with which you can play in the market. Now, the investor desires to make a maximum possible investment. Investor desires to make a maximum possible investment where value at risk should not exceed the balance lying in his bank account. So VAR is given to you and it is 6,99,000. No, sir, you are wrong. You might say that. The statement clearly says that VAR should not exceed the balance in bank account, and the balance in bank account is 7 lakhs. But you are wrong at this time, my friend. Although the statement is written like this, but it means that the loss cannot be more than, or we can say that the balance in the bank cannot be more than the VAR. So how much loss we can bear? How much is the capacity to bear? How much is the capacity of an investor that he can bear a loss, the maximum loss? So all in all, I can say that 1,000 rupees is something which I cannot withdraw from the account, and the balance lying in the bank account for the loss is only 6,99,000. The balance lying in bank account is 7 lakh, but balance lying in the bank account for bearing this loss is only 6,99,000. So this is the difference. You cannot say that if they are saying bank balance is 7 lakh, then the VAR should also be 7 lakh. The VAR should not be 7 lakh, it is only 6,99,000. Because we have this much of the balance only in the bank account for the VAR, for the loss. The standard deviation of market price of the security is 1.5% per day. But we will be using this amount for 4 days. The required confidence level is 99%. It should immediately come into your mind that the z-score is 2.33. You can clearly see that the 99% comes down to here. If you interpolate this, you will be able to calculate it, 2.33. Okay, there is no need for the rest of the table. You are required to determine the maximum possible investment. Maximum possible investment. Now, I'm writing in equation format, the entire answer in equation format. What the institute has given in the suggested answer is this table format, which is little difficult according to me for understanding of the student. So I'm writing it down here. What they want us to calculate is the total investment. Okay. VAR for 4 days should be, how to calculate the VAR? Standard deviation for 4 days, or we can calculate the standard deviation. Chalo, let's write down into z-score. Am I right? Next, how to calculate the standard deviation for 4 days? Standard deviation of 1 day into under root t into z-score. Am I right? How to calculate the standard deviation for 1 day? Let's say x is the amount, maximum amount of investment that you can invest, into 1.5%. Am I right? 1.5% is the 1 day VAR or 1 day standard deviation here, and we also want the 1 day standard deviation here, into under root 4 into 2.33, and the VAR for entire 4 days is 6,99,000. Now let me now just give me an answer. What is that which I need to explain from this step onwards? The only thing to do is the mathematics. Now you just do the calculation and you will get the x. So x into 4 square root into 1.5 into 2.33 goes to 6.99. 6,99,000 on this side, 6.99 on that side. X is equal to 1 crore. It means the maximum that you can invest where your VAR in 4 days will be limited to 6,99,000 is 1 crore rupees. Now the question will come to your mind, sir, how I can invest 1 crore rupees when I am having only 6,99,000 rupees in the bank? It is possible. Let me tell you one thing. This concept is called as the margin requirement. Now let's explore a little. From the bank account, what you will do on that day, you will transfer the maximum possible amount, that is 6,99,000. You have 7 lakh in here. Out of that, 6,99,000 will be transferred, Here you will have 6,99,000. Okay. Now just understand the concept. If you want the delivery of the share in your demat account, you will only be able to purchase the shares worth 6,99,000. But if you are ready to play intraday, then the SEBI does not want you to invest entire amount for that much of the investment. It means that, let's say for example, you want to buy certain share of ABC Limited, and if you want to buy only 1 lakh rupees of the shares of ABC Limited, SEBI will say that if you are playing intraday, you just have to deposit the margin requirement, which is only 20,000. What does that mean is, your 20,000 will get deducted from 6,99,000 and you will be able to create a position of 1 lakh rupees. This will be your investment value. But the actual cash outflow will be 20,000 only. Why the SEBI does that is that when you are playing intraday, SEBI knows that if you are buying the shares in the morning, you will be selling it by the end of the day. So anyhow, you will be returning that product to the market, right? You are not taking that product to home. So anyhow, you are just playing on the prices. You are not interested in the product. So why to take the entire figure and then return the entire figure? So what SEBI does is, when you buy the share, it calculates that how much is the risk in that share. If the share can fall maximum by 20% in a day, that means you cannot lose more than 20%. Then in SEBI will say that you just deposit the 20% figure na. Why you are depositing the entire amount? You just deposit 20,000 rupees and we will create a position of 1 lakh rupees for you, because you are going to close that position anyhow by the end of the day. This is how with less amount we can create a bigger picture of investment. So with 20,000 rupees you created an investment of 1 lakh. In the similar manner, we are saying that with 6,99,000 rupees we can create an investment of 1 crore over a period of 4 days. This is just one day, my brother. 4 days. Yes, this is the margin. This is actual cash, and this will be your investment position. This is done for the purpose of intraday trading, and anyhow the question clearly says that you can use this much of the amount from Tuesday till Friday. That means after Friday you should be back in the bank account with this much of the amount, right? So that's it. So ultimately what I want to say is, creating a position of 1 crore is possible with this much of the amount, 6,99,000. It all depends upon the margin requirement by the SEBI. Mostly it is 20%. If we calculate it, this comes down to 6.99% only. But please understand, this 6,999% is for 4 days. If we take 20%, let's just take 20%, okay? So 6 lakhs, if we take the standard 20%, na, so divide 6,99,000 by 20%. It means every day you can create a position of 34.95 lakhs. And in 4 days you will be able to creating a position of 1.4 crore. That was just 1 crore, my friend. So is it possible? Yes. The maximum that you can create with 20% marginal requirement is 1.40 crore. And we were just talking about 1 crore only. So this is how you should answer. Now in the table also they have given the same thing, but I think you will be better able to understand the question with this formula thing that we have been learning from the very beginning. So just write it down below this table in the compiler itself and you will never forget that. That's it. This is the end of the question. You can just pause the video and write it down, and I will just take a leave from here. We are finished with chapter number 2. One thing that I should explain here is the revision of the formulas of this chapter, at least. You can clearly see it here. We have used these two formulas a lot in this particular chapter. these two basically. You can clearly see var of the portfolio square is var of a square plus var of b square plus 2 into var of a var of b correlation coefficient of ab. This formula can be compared with this formula of variance, right? Are you getting it? So the first thing that we learned in this chapter is how to calculate z-score. Z-score is equal to x minus mu divided by standard deviation. This x is nothing but the var. And if we calculating var with this formula, mu should be taken as 0. And automatically the formula becomes var is equal to z-score into standard deviation of t days. Now, for multiple days, standard deviation of 1 day into under root t can be taken. Okay. So z-score into standard deviation of 1 day becomes var of 1 day. Okay. Standard deviation for multiple days is standard deviation of 1 day into under root t. Portfolio variance, we do not take the weights. Understand, the weights are not taken in this formula because we are calculating the variance in currency. Same goes with the portfolio var. We can use these formulas. That's it. This is the end. In the next lecture, we are going to start with security analysis. My request to you is please go through the theory of security analysis before starting the lecture. You should complete the theory along with me. It is not covered in the fast track, so you should do it by yourself, and it is not necessary that in the very first reading you will be able to remember everything of the theory. 5 readings at least should be required on the theory. So it is your first reading, just go through it. Whatever you remember, that's okay. If you do not remember anything, that's all okay. Then come down to the lecture and solve the questions with me. There are only 2 concepts in this security analysis chapter for the practical questions, that is EMA and run test. There are 5 questions basically, 2 concepts, 5 questions. 5th question is from the portfolio management, and we will shift it to portfolio management itself. That means after completing the portfolio management chapter, I will cover the 5th question of security analysis. But rest of the 4 questions will be solved in the class, out of which 2 will be homework because they are of similar nature, and 2 will be done in the class. So we are going to finish the security analysis chapter in terms of practical question in, I think, 1 lecture only. I will see to that later on. But that much is the plan right now. This much is the plan. For now, please understand that before I solve any practical question, you should go through the question, understand it, do the markings, and try solving it. Don't ever skip the approach that I told you in the very first lecture. If you skip that, you are on a wrong path. Then these classes are not going to help you. First, you should solve the question, no matter what you do in that copy. The answers are, if the answers are wrong, let it be, but you should first go through it and then come down to the lecture or the compiler's answer in order to understand the mistakes. Failing and understanding the mistake and improving again and again is more important than just directly understanding it from the teacher. Bye bye for now.